Welcome to the new home of the Asian guy. The old channel is gone. The voice is not. They tried to erase years of work, but pressure creates momentum, not surrender. This channel is bigger, sharper, and more dangerous to the mainstream narrative than ever before. No fear, no backing down, no silence. We started again. Today is Thursday, May 14th, 2026. Silver is sitting at $84.35, down $3.02 on the day, down 3.45%. Take a screenshot of that number right now. Not because you should panic, because I want you to have a reference point for what you are about to understand. Because that number, $84.35, is not a price that reflects the world as it actually exists today. It reflects the world as the paper futures market wishes it still existed. And there is a difference between those two worlds, so vast, so structurally documented, and so mathematically verifiable that when the gap finally closes, the people holding physical silver are going to remember this Thursday as the moment before everything changed. I have been in this market long enough to recognize the architecture of a pressure event before the pressure becomes visible. Right now, every variable I track is in the red. The global energy infrastructure has sustained damage that analysts are calling a 3 to 5 year repair timeline. The food supply chain is entering its most acute disruption since World War II. The United States stock market is floating at the highest valuation bubble ever recorded in modern financial history. Not elevated, not stretched, but historically unprecedented. The banking system is more structurally exposed than it was going into 2008. And silver is at $84, like none of this is real. That is not stability, that is a lag. And the lag is closing. Stay with me, because by the time I walk you through what is actually sitting underneath this market right now, you are going to understand exactly why this is the week you need to be paying attention. Let me be precise about what the current price is and is not telling you. $84.35. That is the bid on silver as I record this on Thursday, May 14th. The day range has already moved from 83.74 on the low to 88.55 on the high. The market is not flat. It is volatile. And volatility on a structurally undersupplied asset in a geopolitical crisis environment is not noise. It is the early tremor before the fault line moves. Gold is at $4,677.30. That number tells you something important. Gold has spent the last 2 decades pricing in monetary debasement, debt expansion, and institutional hedging demand. It went from around $400 per ounce at the start of the century to over $4,000. That is a 10 times move. Silver, which started in the same single-digit range at the same time, is at $84. Silver has not kept pace with gold's repricing. Not proportionally, not historically, and not relative to the industrial demand explosion that has been building for the past 5 years. That gap is not because silver is less valuable. It is because silver has a deeper paper market, a more complex suppression infrastructure, and a retail-heavy ownership base that is easier to shake out during manufactured pullbacks. When the repricing comes, silver does not catch up gently. It catches up violently. Because the energy required to hold it down against fundamental pressure is enormous, and when that pressure exceeds the holding capacity of the paper market, the release is nonlinear. What the $84 price is hiding right now is the specific combination of structural events that have already been set in motion and cannot be undone. Let me walk you through them. Here's the specific catalyst architecture that is now irreversible. The war in Iran caused infrastructure damage across the Persian Gulf region that will require 3 to 5 years to fully repair. Mike Maloney, one of the most rigorous analysts in the precious metals space, stated this directly at a conference this week. Not 3 to 5 months, not 3 to 5 weeks, 3 to 5 years. That is not a temporary disruption to the energy supply. That is a permanent reduction in global oil and gas output for the foreseeable future, baked into the structural reality of the market right now today as silver prints 84. The Strait of Hormuz has been largely shut off for more than a month since the conflict escalated in late March. Approximately 1/3 of the world's oil supply and 1/3 of the world's fertilizer transits that waterway. Both have been severely disrupted. And the damage is not just logistical, it is physical. Qatar is the largest exporter of liquefied natural gas on the planet. Iran damaged Qatar's production infrastructure during the war. The largest single natural gas field in the world is now operating at reduced capacity. The repair timeline for that specific infrastructure is 3 to 5 years. That is the same timeline as the broader regional damage, which means the world is not just temporarily short on energy. It is entering a sustained period of structurally lower output with no rapid fix available. Now let me connect this directly to silver through the fertilizer channel, because this is the part that most people in this space are not talking about yet. Fertilizer is manufactured primarily from natural gas. Natural gas infrastructure in the region is damaged and will remain compromised for years. Fertilizer prices have already nearly doubled from pre-war levels, and that data point is weeks old. The actual current price is likely worse. Here's the number that should stop you cold. 73% of farmers in the southeastern United States, peanuts. Cotton specialty crops, some of the most productive agricultural land in the country, have publicly stated that they cannot afford fertilizer at current prices for this season's crop. That is not a marginal group of struggling farms. That is nearly 3/4 of an entire agricultural region saying they cannot plant at today's input costs. When 3/4 of a major agricultural region cannot afford to plant, the output of that region contracts. A contraction in food supply enters a market that is simultaneously experiencing an energy cost shock on every other input. Diesel for planting and harvesting equipment, petroleum derivatives for herbicides and pesticides, energy costs for food processing and distribution. The inflationary multiplier at the grocery level will be severe, and it is not coming. It is already decided. The planting decisions are being made right now. The crops that are not going in the ground this week are already absent from the harvest forecast. Silver is the asset that reprices hardest during food and energy inflation simultaneously. Every time in modern history that both variables have moved together at this magnitude, physical metals have been the primary beneficiary of capital rotation. And today, both variables are in motion at a scale the modern commodity market has not seen before. Now, let me tell you what the analytical community that has been right about this market for 20 years is doing right now. Mike Maloney began warning publicly about the structural vulnerabilities in the global financial system in 2004. At that moment, gold was trading around $400 per ounce. Silver was in the $4 range. The mainstream financial consensus called him early. His peers called him pessimistic. His analysis was accurate. Gold moved from 400 to over 4,000. That is a 10+ times return. Silver moved from 4 to over 80. Both assets dramatically outperformed equities, bonds, and real estate over that same period. The people who acted on that structural analysis in 2004 made wealth that has compounded through multiple market cycles. He is now making the same structural argument, but with the following differences. The bubbles are larger. The geopolitical stress is more acute. The energy infrastructure damage is more severe. The debt levels are more extreme. And the food supply disruption is a new variable that did not exist in previous cycles at anything close to this magnitude. The Bulletin of Atomic Scientists reset the doomsday clock to 85 seconds to midnight at the beginning of January this year. That was before the Iran war escalated, before Qatar's gas infrastructure was damaged, before the Strait of Hormuz went offline for a month and counting, before fertilizer prices doubled and 73% of southeastern U.S. farmers said they could not afford their inputs. Maloney's direct assessment: if the Bulletin of Atomic Scientists were resetting that clock today, it would be below 60 seconds, below 1 minute to the most severe catastrophic risk scenario on Earth. The smart money that has been right about this market for 2 decades is not treating this as a dip to trade. It is treating it as a structural inflection point to position through. Let me now walk you through the mechanical structure of why the silver repricing, when it arrives, is going to be violent rather than gradual. This requires understanding the bubble that silver's move will break out of and against. The Buffett Indicator, which measures total stock market capitalization as a percentage of the U.S. gross domestic product, is currently sitting at 232.6%. Maloney presented this data at a conference this week and described it, using the word precisely as the greatest bubble in all of recorded financial history. Here is the historical calibration. For the century spanning roughly 1880 to 1980, the average Buffett Indicator reading was 50 to 60%. That was the norm across booms, busts, wars, and recoveries. The 1929 peak that triggered the Great Depression was well below current levels. The 2000 NASDAQ bubble, the most extreme equity overvaluation in living memory until now, was well below current levels. The 2007 real estate bubble that caused the global financial crisis was well below current levels. Today's reading of 232.6% has no historical precedent. We are in territory that has never existed before in the data. The PE ratio data confirms the same finding from a different angle. For most of American financial history, the average price-to-earnings ratio for large-cap equities was between 14 and 15. Anything above 20 was historically treated as a warning signal warranting caution. Today, investors are paying PE multiples of 30, 40, and 50 for ordinary large-cap companies. Some technology sector names are trading at multiples of 100 or higher. A handful of companies carry no earnings at all, producing an infinite PE ratio, and investors are still buying at elevated prices. Maloney offered a third measure that is perhaps the most visceral. The average cost to purchase one share of the S&P 500 expressed in hours of human labor has averaged approximately 23 hours throughout American history, going back to the Civil War era. As of his most recent data point, that figure is approximately 150 hours. The historical norm is 23 hours. The current reality is 150 hours. That gap has no historical parallel in any dataset he has reviewed. Now, here is the mechanism that connects this bubble architecture directly to silver. Equity bubbles do not simply deflate, they rotate. When PE ratios compress from 50 back toward their historical average of 15, the capital that was priced into those valuations does not disappear. It migrates. The question is always, migrate to where? Sovereign bonds are not the destination in an environment where U.S. debt to GDP is at the highest level in American history, higher than the post-World War II debt burden that took decades to work down. When sovereign credibility is compromised, bonds are not a haven. They are another risk. Real estate is not the destination when commercial mortgage-backed securities delinquency rates are already running above the 2008 crisis peak, when private credit default rates are at all-time highs, and when the construction cost inflation driven by energy and materials price spikes makes new supply dramatically more expensive. That leaves physical hard assets, gold, silver, and productive commodities. The rotation into these categories during equity bubble deflations is not a theory. It is the documented historical pattern. And in this cycle, the rotation will find a silver market that is simultaneously experiencing its own independent demand pressures from industrial supply constraints, geopolitical supply chain disruptions, and currency debasement mechanics. When multiple independent catalysts point at the same asset simultaneously, the resulting price move is multiplicative, not additive. Let me ground this in the pattern of record, because the track record here is not ambiguous. Maloney began his public warnings about the equity bubble and the case for precious metals around 2004. Gold at 400, silver at 4. The mainstream called him wrong for years. Then, the 2008 financial crisis arrived and both metals surged as capital rotated out of collapsing paper assets. Gold ultimately traveled from $400 to its current level above $4,600. Silver traveled from $4 to its current level above $80. Both performed that move before the current crisis conditions existed. Before the Iran war, before Hormuz, before the fertilizer disruption, before the Buffett Indicator reached 232%, before commercial mortgage delinquencies exceeded 2008 peaks. The performance case for precious metals over the past 2 decades is not built on speculation. It is built on the structural reality that fiat currencies lose purchasing power by mathematical design, that the debt cycle requires inflationary resolution, and that hard assets with finite supply are the natural destination for capital seeking to preserve itself across that debasement. Now stack the current conditions on top of that historical baseline. The same foundational case exists: dollar debasement, debt expansion, currency credibility erosion. But layered on top are conditions that have no modern precedent: a permanent regional energy supply reduction, a food cost shock entering at the same time an equity bubble more extreme than any prior measured peak, and a banking system that entered the current cycle in weaker structural condition than it entered 2008. Every variable that drove the prior 2-decade run in gold and silver is still fully active, and multiple new variables of equal or greater magnitude have been added. The pattern is not new. The scale is. Now let me show you the full depth of what is sitting underneath this market, because the energy and food crisis is not the ceiling of this story. It is the entry point. United States debt to GDP is currently at the greatest level in the country's recorded history. For perspective, Maloney highlighted that this exceeds the debt burden that existed after World War II, a war that required mobilizing the entire industrial capacity of the nation for years. After World War II, the United States had factories, infrastructure, export dominance, and a booming demographic entering productive years. There was a natural growth trajectory to grow down the debt burden over time. What exists today is a debt load of that magnitude entering an energy shock, a food cost crisis, and a potential corporate earnings recession simultaneously. There is no natural growth trajectory that absorbs that debt burden while those headwinds are active. The resolution pathway is monetary. The Fed prints, the debt is inflated away. Every dollar created in that process is a dollar that bids against you at the pump, at the grocery store, and at the property management office. The banking system is not a buffer. Banks are carrying bond portfolios purchased at the near zero interest rates of the post-2008 era. As rates rose, those bonds declined in value. Those declines sit on balance sheets as unrealized losses. Maloney stated this explicitly. The banks are all upside down right now. They were not in this structural condition in 2008. They are entering the current potential credit cycle deterioration from a weaker starting position than they entered the global financial crisis. Commercial mortgage-backed securities delinquency rates are already running higher than at the peak of the 2008 crisis. Private credit default rates are at all-time highs. Google search data for distressed real estate terms is at levels that have no recent parallel. China's residential real estate market, the single largest investment vehicle for Chinese household wealth, has already declined 25% over the past 2 years. A global recession triggered by the energy and food disruptions now in motion would not stay in one geography. It would export asset deflation and import commodity inflation simultaneously across every major economy. In that environment, the asset that wins is not the one with the highest prospective return. It is the asset that cannot be diluted by a central bank decision, cannot be zeroed by a corporate bankruptcy, cannot be frozen by a banking system under stress, and cannot be devalued by an act of government. Aristotle named the attributes of real money over 2,000 years ago: a medium of exchange, a unit of account, and most critically, a store of value. Physical silver meets every criterion. The paper instruments currently dominating most portfolios fail the third test by design and by mathematical certainty. The dollar has lost the overwhelming majority of its purchasing power since the Federal Reserve was established in 1913. That is not an accusation. It is the documented arithmetic of a fiat currency system where debt creation is the mechanism of money issuance. Every ounce of physical silver you hold is not a bet that silver appreciates. It is a hedge against the mathematical certainty of continued fiat depreciation. And that certainty is now accelerating under conditions of energy cost inflation, food cost inflation, and debt monetization all arriving together. Let me walk you through the specific sequence of consequences that are already embedded in current conditions. This is not a forecast. These are outcomes that are mechanically inevitable given the inputs already in the system. Step 1 is complete and locked. The infrastructure damage from the Iran war is done and irreversible on any timeline shorter than 3 to 5 years. Brent crude spiked from approximately $65 to $70 per barrel before the conflict to around $108 at current levels, with the OPEC basket hitting approximately $140 at peak panic pricing. That is not a temporary spike that unwinds when tensions ease. The infrastructure that produced the pre-war supply level is physically damaged. Supply has structurally contracted. The price floor has moved up permanently. Step 2 is already in progress. Fertilizer prices have nearly doubled. Wholesale gasoline prices have moved from approximately $1.80 per gallon to above $3.50. Every single input into the food production chain, planting, herbicides, pesticides, harvesting, processing, transportation, has spiked simultaneously. The inflationary multiplier across the food supply chain is active right now. 73% of southeastern U.S. farmers cannot afford their inputs at current prices. Christine Lagarde, president of the European Central Bank, has publicly warned of potential food rationing in Europe due to the fertilizer disruption through Hormuz. When the head of a central bank is using the word rationing publicly, the internal projections are almost certainly more severe than the public statement. Step 3 arrives over the coming months as crop output contracts grocery prices escalate sharply and the food inflation headline enters the mainstream financial conversation. This step is already decided. The planting shortfall is being set right now. The harvest that does not happen this season cannot be created retroactively. Step 4 is the financial system's reflexive response to the combined energy and food inflation shock. Every energy price spike of 50% or more in the past 40 years has produced a recession. The current spike meets that threshold and is sustained by structural supply damage rather than a temporary demand surge. A recession entering a stock market at 232% of GDP with commercial real estate already in distress and bank balance sheets underwater is not a normal cyclical correction. It is the beginning of the bubble deflation sequence that Maloney has been describing as inevitable for the past several years. Step 5 is the Federal Reserve response. Print. That is not speculation. It is the documented institutional reflex at every prior crisis point. Currency creation in response to a deflationary credit shock inside an inflationary energy and food cost environment is the most dangerous monetary combination possible. It does not arrest the inflation, it amplifies it. And every wave of currency creation is rocket fuel for the hard assets that are priced in that currency. Silver's role in this cascade is not peripheral, it is central. Industrial demand is already absorbing above-ground supply at a rate that has kept inventories at historic lows. Physical supply chains are constrained, and the financial system rotation that occurs at each of these steps sends additional capital toward the same fixed supply of metal. Now let me give you the full frame of what this moment represents, because the energy and food crisis and the equity bubble are not the final chapter. They are the triggering mechanism for something larger. The core argument that Mike Maloney has made consistently for over 2 decades is not complicated. Fiat currency is not money. It is currency. There's a difference. Money stores value. Fiat currency, by the mathematics of its creation, cannot. The debt that creates fiat currency must be inflated away over time. That is not a flaw in the system. It is the feature. Every fiat currency in all of recorded history has eventually gone to zero. The dollar has lost the overwhelming majority of its purchasing power since 1913. That arithmetic has not changed. It has only accelerated. Gold traveled from $400 to $4,677 over the past 2 decades as that debasement arithmetic continued to run. Silver traveled from 4 to over 80. Those moves reflected the dollar's declining purchasing power, not any magical property of the metals themselves. Now add the current structural conditions to that baseline trajectory. The dollar is not just losing purchasing power through the slow arithmetic of debt-financed currency creation. It is being subjected to rapid purchasing power destruction through simultaneous energy inflation, food inflation, and the prospect of debt monetization at scale in response to a financial system under multiple types of stress at once. Robert Kiyosaki, who has collaborated extensively with Maloney and shared platforms with him for years, has made the same point from a different angle. Cash is not money. Every moment it sits in a savings account, a money market fund, or a checking account, it is losing value relative to the real assets it could have purchased. That statement was true in the moderate inflation environment of recent years. It is far more true in the current environment where energy, food, and construction costs are all repricing simultaneously. The doomsday clock at 85 seconds to midnight set before the Iran war escalated, before Qatar's gas fields were damaged, before the Strait of Hormuz went offline. That is not just a geopolitical measure, it is a systemic risk indicator for the stability of the entire global order that the dollar's reserve status depends on. A world in which 1/3 of global oil and 1/3 of global fertilizer cannot move freely through a single waterway is a world in which dollar-denominated commodity pricing is under structural pressure from every direction. The silver price at $84 has not been asked to reflect any of this yet. The paper market is still operating as if the pre-war structural reality is intact. It is not. The inputs are in the system. The cascade is underway. And silver, sitting at $84.35 on Thursday, May 14th, 2026, is the most underpriced structural position in the entire commodity complex relative to what the fundamental data already requires. Let me give you the specific sequence of indicators to monitor, because I want you to be prepared for the cascade as it becomes visible in real time rather than reacting after the fact. Watch the fertilizer price data. The near doubling that was already reported was based on data that was weeks old at the time of Maloney's presentation. Current fertilizer prices are likely worse. When fertilizer prices move significantly above the doubled level, crop yield projections for the current season will begin to be revised downward formally by the USDA and by European agricultural authorities. That is the moment the food inflation story transitions from analyst warning to mainstream financial headline. Silver historically moves hard when food inflation enters the mainstream narrative. Watch the energy complex for resolution signals. The Strait of Hormuz situation has no rapid resolution available given the physical infrastructure damage timeline of 3 to 5 years. Every week, without meaningful resolution, is another week of structural supply shortfall accumulating in the global energy system. Watch oil price behavior around the 110 and 120 level. Because above those thresholds, the consumer purchasing power compression accelerates in a way that triggers rapid credit deterioration. Watch commercial real estate delinquency disclosures. Banks reporting commercial mortgage exposure losses are the leading indicator for the credit cycle deterioration that triggers the Fed's currency creation response. That response is the direct catalyst for hard asset repricing. Watch equity market PE compression. When the S&P 500 begins moving from current valuations toward historical averages, the capital-seeking exit from overvalued paper needs somewhere to land. The size of that rotation, given the scale of the current bubble, is historic. Physical silver's market is small relative to the equity market. A modest percentage rotation produces a massive price impact. Watch physical supply indicators, COMEX registered vault inventory, mint availability, dealer premiums. When physical premiums begin expanding meaningfully above paper prices, the paper market is being dragged toward reality by physical demand. That gap expansion is one of the most reliable leading indicators for paper price moves in the silver market. Each of these triggers operates independently. Any single one of them in isolation would be a meaningful catalyst. All of them are simultaneously in motion. The question is not whether the repricing happens. It is whether you are positioned when the first visible trigger breaks above its threshold. Let me ask you directly, because this is not abstract. Where is your wealth positioned right now? If it is in equities, you are holding assets at 232.6% of GDP, with PE ratios between 30 and 100 for average companies entering a simultaneous energy shock food cost crisis and potential credit cycle deterioration. The bubble architecture Maloney has documented has no historical precedent. The conditions now impinging on it have no modern parallel. If it is in cash, you are holding an instrument that has lost the overwhelming majority of its purchasing power since 1913, that is being actively eroded by energy and food cost inflation right now, and that will be further devalued by whatever currency creation the Federal Reserve deploys in response to the financial system stress building in the banking sector, the commercial real estate sector, and the corporate credit market simultaneously. If it is in bonds, you are holding sovereign debt at record debt-to-GDP levels, issued by a government whose tax revenues are about to be compressed by a potential corporate earnings recession and whose central bank response is structurally inflationary. The banks holding these same bonds are already underwater on their portfolios. If it is in physical silver and gold, you are holding the asset class that outperformed every one of the categories above over the past 2 decades, starting from the same conditions that exist today, but at a fraction of the current stress level and a fraction of the current geopolitical risk premium. Maloney warned about the bubbles in 2004. He was early by years. The people who waited for mainstream confirmation paid $400 for gold that was available at far lower prices when the structural analysis was already clear. Silver was the same story. The structural analysis is more clear today than it was then. The conditions are more extreme. The risk is more immediate. And the price of silver at $84 still does not reflect any of what the data already shows. Being positioned in physical metal at this moment is not a speculative bet. It is a response to documented structural reality. And the time gap between documented structural reality and market acknowledgement of that reality is exactly where the opportunity lives, and exactly where it closes violently when it does. If this breakdown gave you clarity, if seeing the energy data, the bubble architecture, the food supply chain mechanics, and the monetary system endgame mapped against Thursday's silver price helped you understand what is building underneath this market, then do one thing right now. Subscribe and hit the notification bell. Because this is not the last data point in this sequence. The fertilizer story is developing in real time. The earnings revision cycle is ahead of us. The banking exposure disclosures are coming. The physical supply indicators are moving. And every time a new piece of this cascade becomes visible in the data, I will bring it to you here on this channel, specifically numerically, and without the mainstream financial media filter that will show you the chart after the move has already happened and explain it as a surprise. There's nothing surprising about what is coming. The inputs are already in the system. The structural damage is already done. The bubble is already at 232% of GDP with no historical precedent and multiple simultaneous pins. The only open question is where you're standing when the repricing arrives. Subscribe, stay positioned, and hold the line.